Hi, this is David Daughtry at Copperwind Financial. Just wanted to do an update of our Dave's talk from back in the summer on China and the impact it was having in their markets. What I'd like to do is go back and review just a little bit of that time frame. And when we look at the Shanghai Composite Index back in July, what we saw is after about a year, what you saw here was that the market had gone up over 100% and dropped back down 20-25%. Now if you go on from there and look and say what did it do after that, because we did that I think right around in this time frame where it was 3,900 to 4,000, when the US market followed it and started to drop down to about 3,000 in August and September, then what you saw is you saw a steady increase back up nearly to the 4,000 level at one point. But what we've seen is a sharp drop off in the Shanghai Composite since then. When you compare it to the US market over the last 2 years, basically the US market, we've said it, the US market has been volatile, but it looks like it's sleeping versus the Shanghai Composite. And you might want to look and say, well, so why do we even care about the Shanghai Composite, and why is it now impacting our markets? Because it clearly is, especially if you go back here and look and see when their market started dropping off. It dropped off, and then it really pushed ours to drop off even more. So why does China matter? Well, let me walk you through why it matters. And this is the last 30 days where you see the Chinese market starting down and then ours starts to follow it, even though we're down a whole lot less. But I will tell you, this was a couple of days ago, and today we're going down another 2.5%. So we're probably at 8 or 9% down. But if you look at global GDP by country, the U.S. clearly number one, but this is back in 2006. And beside us, we had at about a third the size, Japan, Germany, then China and the U.K. and France, all sort of in the same boat. The difference is, fast forward now 10 years, and what's happened, and I apologize because it's a different chart because I couldn't find the exact same one with the 2014 numbers. But now you look at the top 10 countries, we're at 17 instead of 13. Japan, Germany, and the UK are still down at 3 and 4, but China is leapfrogged above all of those and is now, at 10. And this is actually 2014, so a year ago. And that's even gone up from there. So what's occurring is China is much, much bigger than it used to be. And it used to be that we were the ones that everybody followed. Now China has become a much bigger player, especially in the commodities. The growth that they have had of 10% or more for the last 20 years has used a tremendous amount of the commodities. And when you look at what commodities have done, and we'll go to that. Here's the iron ore prices 5 years, over the last 5 years, and you see they were at $180 a ton. They're down at 40. Aluminum prices, sort of the same thing, not as extensive, but they were up at 18. They got all the way down to 10,000. You look at copper, it was up at 4.5. Now it's down per pound, and now it's down at below 2. All of those are the largest user of those commodities has been China. Now China, as we go back and look and we say, well, yeah, they're growing tremendously. People have said that China is officially saying that they're growing about 7% a year. But when you look at these numbers on all of the commodity prices, they are probably not. In fact, one of the things that was brought up last year when they were slowing and they said, oh yeah, we're still growing about 7%, was that electricity usage throughout China had grown only about 1.4% a year over year. Well, you're going to have a lot more growth in electricity usage if your economy is growing 7% a year. So is it growing? Yes, it's growing. Is it growing as fast? Probably not. Now, when we go through here, back the response that China had to the market slide in 2015, the government is very much it's been a controlled economy since Mao Zedong took over in 49. And they don't like, they're trying to develop themselves and do a free market, and they're doing a lot of free market type stuff, but they still like to control things. So when you had a 20 or 30% slide of the market in 2015, what the government did is they stepped up and they prohibited the state investment funds from selling any stocks, and they are a substantial buyer of stocks, a holder of stocks, and so they stopped them from doing that. If you own 5% of a company, which there are a lot of companies that are controlled by some major shareholders over there, you were prohibited from selling any of your holdings in that company for 6 months, and that actually expired just a couple of days ago, I think. And they also instituted circuit breakers, which we have had here in the U.S. for probably since 1987, with the crash that happened in '87. And those are basically things that when the market goes down a certain period of time, you sort of stop trading, let the market settle out, and then you'll resume trading. And they implemented those. It seemed to stabilize some back then, and then the market sold off another 25% after that. Their response to the current slide, which has been, in the Shanghai market, 15 to 20%, and in the Shenzhen market, which is sort of from a volatility standpoint, somewhere like our NASDAQ, which is down like 23%. What's happened there is in the first week of 2015, there were 7% daily market slides that closed the markets for 2 days. What I mean by that is their circuit breakers were that if the market goes down 5%, you stop for 15 minutes, and then if it goes down, so it's down 7% for the day, you close the market for the day. Now, what they found is that when they got down 3 or 4%, all of a sudden the market would jump down lower because people would try to sell to get out before the market was closed. And so by Friday, a week ago, they basically suspended those circuit breakers. In the U.S., we don't stop trading completely. We don't close for the day unless the market's down 20%. And those circuit breakers have helped here. In this second week, there's been 3 days that there were 3 to 5% down days, and in fact yesterday was one of them. And so the Chinese markets have entered bear market territory. One of the things that they've tried to do is to really put the kibosh on speculators, both in the yuan, which is their currency, and in the stock market. So back in the summer, they basically suspended anybody's ability to short a stock, and that seemed to help some, only temporarily. But one of the things that they did this week was if you're shorting the currency, you have to borrow, and that overnight rate has been on an annualized basis about 5%, 5 to 7%. On I think it was Monday or Tuesday, to really put the kibosh on speculators, they jacked that rate up to 66%. Overnight on an annualized basis, and immediately I'm sure you're going to see some reports of hedge funds that got killed in that deal. But they're trying to keep speculators out, and if you put the cost of borrowing money at 66%, everybody stops borrowing money. So anyway, that's what you're seeing in the current Chinese response to the market. The conclusions we come to, there's going to be continued volatility in the global markets until you see the economics in China a little bit clearer and people get comfortable that the numbers are real. I think that is going to take some time. During that time frame, the U.S. markets are going to be tied to China, and I think there is a significant risk of a recession or a significant slowdown in the West. Maybe it's not a recession. Maybe we go from 2 or 2.5% to 1 or 1.5% if this continues, because China, even though we think of importing a lot from China, we also export a lot to China, and you are seeing both over there and worldwide a slowdown in profits for companies, and that is typically not good for the stock markets overall. And when you look at that, that may have an impact on the Federal Reserve in their raising of rates. Not that they won't raise rates this year, but some of the estimates are that they'll raise them 4 or 5 times. Maybe that turns into being just a couple of times. So anyway, just wanted to give you an update on what's happening in China and how that impacts our markets. Thanks for listening.